I will be talking about IPOs, but looking more at the anatomy and lifetime of a capital markets transaction. I'm told I have maximum 20 minutes here to do it, so it will be a little bit like your holiday hop-on, hop-off bus tour. You will see quite a lot in a relatively short period of time. Now I'm trying to, how can we make it full screen? Yeah. Okay, that's full screen. I would like to keep this presentation as practical as possible, so I've chosen one recent transaction that I will go through here. It's the IPO of state-owned company in Slovenia, Nova Ljubljanska Banka. You may have heard it was one of the big IPOs last year in Europe, in the FIC industry, a very successful transaction. The reason why I think it's appropriate for this audience is twofold. First of all, it's an IPO of a state-controlled company, and second, Slovenia in some ways similar to Latvia, looking at the size of the economy and the market. So 670 million IPO of Nova Ljubljanska Banka completed in December last year. Let's start with what I call a typical timeline. For those of you who have not done it, have not done this type of transaction, let's focus on the key points. The key points are in the middle. Let's starting with the kickoff meeting and the milestones that follow. One important part, of course, in every IPO is the analyst presentation, the pre-IPO research, a very customary and very important part of the price discovery mechanism, very common in Europe. For those of you who are familiar with the US model, the pre-IPO research doesn't exist in the United States for many reasons. They use the buy-side research on the basis of publicly available information as opposed to the pre-IPO research. Having said that, the UK model has recently changed in July last year. It is becoming more similar to the US model, and the UK regulator is now giving access to unconnected analysts as part of the IPO process. The intention to float, so this is the first message to the market that you are planning an IPO. Of course, it's the big time. Everyone should be ready by that point in time. This is also the time when the research is published, and what follows is that blue line on top of intention to flow is PDIE, which are meetings between the research analysts and analysts who prepared research and a selected number of investors. What follows later is the price range prospectus. Of course, you need to come up with a price range for your offering. Now, this applies only to public offerings in Europe. If there is no retail component, if you don't want to go with an approved prospectus, there are, of course, other ways, and you can use what we would typically call the Pathfinder type of prospectus. Roadshow follows the price range prospectus. Of course, within the price range, you need to get to a point where you agree on the final price at which you will be selling the instrument, and this happens at pricing. You see in the blue or orange boxes below how the share price of NLB has developed from the time of the pre-IPO research through the price range prospectus, through the pricing. Now, pricing for bankers, and please, bankers in this room, don't take it the wrong way. Pricing is when the transaction stops for bankers, but for lawyers, it still continues. There is still quite a lot of plumbing to do to get the transaction over the finish line, in particular to make sure that the transaction settles. And there may or may not be challenges. My personal experience focusing on the CE region is, let's say, emerging markets, frontier markets, is that there may be challenges. I can tell you anecdotes and stories. My recent transaction from Hungary 2 years ago, without changing the laws, which we had to do and lobby the parliament to change the laws, the transaction, the IPO would settle on a T+25 basis, which was not really favored by anyone in the group. But we did successfully lobby the parliament. The parliament changed the laws to make this transaction possible, and we settled the transaction on a T+2 basis. So that's closing, and what follows after closing, of course, it's now allowed under the market abuse regulation is the stabilization. It's the short period of time of 30 days when one of the banks will carry out stabilization in the market, effectively buy shares if the share price goes below the final price. Of course, you cannot stabilize if the share price increases. That would be market manipulation. So in our case, when you look at the share price, you will see with NLB prices at 51 euro. Shortly after closing, the share price went up. In that case, the banks decided to exercise the overallotment option, the green shoe option, and they closed the overallotment part of the offering. And at that point in time, the share price was 57.2. Now, many people ask me how long it takes to do an IPO, and maybe going back to the point that we just heard, a lot depends on how prepared the company is, right? The corporate governance structure is one point, but there are, of course, many other aspects that are relevant, right? The financial statements, how the company is organized internally, the internal controls, and a few additional points which will be relevant from a due diligence perspective. The blue line, the orange line that cuts across the whole line is due diligence, right? In any capital markets transaction, due diligence plays a very significant role. It's something not only for lawyers. The banks these days are, at least in my experience, are much more focused on due diligence, not only the AML, the sanctions part of the due diligence process, which is driven by regulations, but more the due diligence about the company. Right? Now, the deal structure, we'll talk about this briefly in a second. It was a Rule 145 regulation as offering. I don't know if those terms mean much to you. Rule 144A means effectively private placement to qualified institutional buyers, which is pretty much the equivalent of qualified investors under the prospectus regulation, but QIPs in the United States. Regulation S, which effectively means it's the US way, the American way of looking at regulation worldwide. Any transaction that happens outside of the United States, from the US perspective, is going to be considered as a Regulation S transaction. Most of the transactions these days above a certain size will be structured as a Rule 145 and Regulation S offering. It we'll talk about it in a second. Public offering in Slovenia, again going to the point that we mentioned previously, local retail offering locally, plus offering of depository receipts and listing on the London Stock Exchange. Looking at the syndicate very briefly, you will see a number of international banks at different levels, and you will see also a domestic bank. Of course, this is required because of the retail portion. Now, the background very quickly, of course, it was an IPO of a state-controlled company. This process was driven in this particular case by the commitments to the European Commission. You may well know the Slovenian government was requested to bring NLB back to the public markets by the end of 2008. There were quite a few attempts, and the last attempt last year was successful. It took in total 5 months. This is in line with how much time we would expect for a transaction of this type, 5 to 6 months. I mentioned trading on the Ljubljana Stock Exchange and the GDRs on the London Stock Exchange. It was one of the largest IPOs last year in Europe, definitely the largest ever IPO out of Slovenia, and the first IPO in Slovenia in 10 years. And we had the privilege to work on this transaction. Now, we talked very briefly in the previous session about listing, right? Of course, looking at your listing options, you have a number of alternatives which you can choose, right? You can list locally, and this is driven by the points that we heard about the previous session. You can go for dual listing locally and elsewhere outside of your home country. This can be London, but this can be Warsaw, or this can be United States, whatever you choose. You can do foreign listing only, and certain companies, probably not from Europe, but from outside of Europe, decide to do it this way. And in a separate category here is the NASDAQ and NYC. And the reason why I mentioned NASDAQ at NYC is because of what we saw last year in the market, which was driven by how the stock exchanges in the United States performed versus European stock exchanges. Approximately mid-half year, we saw quite a lot of interest and questions about listings in the United States. Single listings, dual listings, different structures, and that was driven mainly by the expectation of valuation in the process. NLB chose the dual listing structure, the local listing, as I mentioned, on the local stock exchange, and the GDRs. Now, the listing venue is, of course, one point. The other point that you need to bear in mind is the offering structure, right? Now, those 2 points are related, but they are not the same, right? I always say that from my perspective as a lawyer, I tend to be listing venue agnostic, because we can structure an international transaction which is listed locally. The Port of Tallinn is one of the examples. It can be a dual listing, but those 2 points are separate. I mentioned Rule 144A offering versus regulation as offering. The home regulator under the prospectus directive, that's an interesting point these days, and again, I could tell you a few anecdotes. You may know under the prospectus regulation, the competent regulator for the approval of the prospectus is the regulator of the country where the company is incorporated. So in the case of NLB, it was the Slovenian regulator. Of course, there was one prospectus which covered shares and GDRs. Of course, the initial question, given the lack of experience of the home regulator with the GDR structure, was, why are you asking me to approve a prospectus for listing of GDRs on the London Stock Exchange, right? And why don't you go to the UKLA in London and ask them to do it? Actually, you cannot. That's what the prospectus regulation says. I also worked on the planned IPO of Citadele Banca here a couple of years ago. Interestingly, we got the same question from the local regulator. The local regulator here was very open-minded, very helpful, very keen to make the transaction happen. But of course, one of the first questions was, why GDRs, right? Why are you asking me to approve those? Settlement and stabilization mechanics, and I think this goes to what I would call the plumbing behind and the infrastructure. Of course, certain countries will be easier, certain countries will not be easier. Oftentimes what you see in this part of the world is that the settlement systems are not connected to Euroclear, so you need to come up, as was the case in Slovenia, you need to come up with a structure that allows you to settle the transaction timely by using different settlement systems. Stabilization, again, just please bear in mind that you have 2 types of instruments listed on 2 stock exchanges, so you need to align the stabilization efforts and activities in the market. And of course, banks do it, banks know how to do it. They are also subject to reporting obligations for any purchases in the market. Rule 144 regulation as, just very briefly, why is it important? Of course, I'm not a banker, so I will not speak here for the banks, but once you exceed a certain threshold, there is a question of building the book and demand, right? In my experience, most of the banks will suggest the Rule 144 component of the transaction, just to make sure that you will be able to tap the US demand, the US qualified investors. Again, this is not a public offering in the United States. You are only dealing with big boys, qualified investors. QIPs are defined roughly as institutions that have over $100 million of assets under management, so big insurance companies, big funds, and so forth. The biggest transactions from CEE, including NLB, the planned IPO of Citadele Banca, Port of Tallinn, were structured as Rule 144 transaction. And of course, the question that we always get is, what does it mean in practical terms? How does it translate into how you draft the prospectus and how you structure the offering? From a 30,000 feet perspective, I would say that the disclosure standards for the prospectus in Europe and in the United States are similar. They were all enacted under the common set of disclosure guidance issued by IOSCO late 80s, and they were implemented in two slightly different ways, the US model versus the European model. Now, in Europe, it's the prospectus directive and now moving toward prospectus regulation, whereas in Europe, it is the set of rules issued by the SEC under the Securities Act. Very detailed rules, a slightly different approach to regulating capital markets, but both systems works. The underlying principles will be the same, right? Both systems are disclosure-based system. What it means that the prospectus will be your liability document, is the legally required document, and also the document to which the liability will attach. But in terms of details, of course, in the US, there will be certain sections of the prospectus which are drafted in a slightly different way, but this is not that different today from the prospectus regulation. Now, maybe a few challenges and solutions in the NLB transaction. Again, state-controlled company on day one. One of the issue was the pre-IPO dividend a few years ago, which in a way had an impact on the timetable. The dividend was paid to the government before the transaction happened. Similar to my experience in Hungary, the Slovenian parliament had to enact new legislation to deal with certain potential liabilities that the bank might have in Croatia, so we dealt with that. And I think the most complex point, which doesn't really come up often in Western countries, was how to make sure that the transaction settles in a timely manner and in a way that everyone is happy, including the investors. So these were the challenges on this transaction. Due diligence, very briefly, and this goes back to the point that I mentioned previously, that orange line that cut across the entire timetable. Due diligence is very important in capital markets transaction. Now, a capital markets transaction IPO is not an M&A transaction. What it means is that lawyers and advisors don't produce M&A type of due diligence reports. The prospectus is the end result of the due diligence process. The rules and regulations tell us that all material information has to be included in the prospectus. So there will be different elements in the overall due diligence process, but the ultimate objective and result is to make sure that the disclosure in the prospectus is correct. Now, many people think that due diligence is something for lawyers, that lawyers go into the data room and review the documents. No, that's just one of the elements of due diligence. There's also the business due diligence, and here the banks will be much more involved, looking at the business model, looking at the business plan, testing assumptions, and talking to the management. There's the financial due diligence, of course, similar to the business due diligence, but this may also involve auditors. The next point is the accounting due diligence. Why is this required? Of course, everyone on a transaction wants to be able to speak with the auditors and ask questions about their work with the company, how they audit, how they review the financial statements. Is there anything that they may be aware of in connection with the work? There's the legal and documentary due diligence, and of course, depending on the industry and depending on the business, there may be specialist due diligence. When does it come up? Mining companies is an example. Real estate companies is another example. Right? In those instances, you will look at additional disclosure in the prospectus, for example, valuation reports for the retail portfolio, and that's the specialist part of due diligence. If you structure, and here I'm going to use another term of art, if you structure transaction as a Rule 144A transaction, the private placement to US investors, we lawyers, US lawyers, will be asked to deliver what's called a 10b5 letter. Right? A 10b5 letter is sometimes referred to as a legal opinion. This is actually not a legal opinion, but this is a part of the comfort package that every investment bank will require on any 144A transaction. It effectively says and I can cite this sentence off the top of my head, it effectively says that nothing has come to our attention, that anything in the prospectus is incorrect or contains material misstatements or omissions, right? So this is, again, this is the end result of the due diligence process. We will be able to deliver our 10b5 letter once we complete the various different elements of due diligence. And I think the last point that I wanted to mention is the IPO research reports. Why is it important? I mentioned previously, very common in Europe, pretty much on every IPO, the pre-IPO type of research reports as a price discovery mechanism, not used in the United States, even though these days it is allowed in certain circumstances, but I don't think anyone uses pre-IPO research in the United States. The way how the process works, of course, to allow analysts to come up and to draft research, the company needs to produce what's called an analyst presentation. It's one of the longest presentation in the process. It's effectively the whole history, the description of the business KPIs, risks, financial information of the company. That pack is given to the analysts. The analysts are also able to ask follow-up questions, and on that basis, they produce research. Of course, a research report is an expression of independent judgment. It's how an analyst views that particular company, what it means in terms of process. Once the company gets to see a draft research report, of course, the company is not expected to influence the decision or the judgment of the analyst. And in practical terms, it means that the company most of the times will receive a redacted version of the research report without the valuation range, right? And the company will be able to look only and check the factual accuracy of the reports. And then when the time comes, the analysts issue the full report with the valuation range. Now the UK, and that's probably the last point that I will mention, the UK IPO model has changed. Now, over the past many years, as long as I practice law, the research reports were produced only by the research departments of the syndicate banks which were hired by the company for the particular transaction. Now, over time, the attitude, in particular in the UK, has changed, and the UK regulator came to the conclusion that in order to level the playing field in the market and allow access to unconnected analysts, meaning analysts which are not in the research departments of the investment banks hired for a transaction, they should also have access to the research reports and to the company and be able to produce research reports. The way how it is implemented in the UK differs now from how IPOs are completed and carried out in Europe. We now have the bifurcated disclosure structure. In other words, the company produces what's called the registration document. That's the base document containing pretty much all of the information about the company, the business, the financial section, the risk factors, the key strengths and strategy. This is published publicly, and after the publication of the registration document, unconnected analysts are invited to join calls, join meetings with the company in case they wish to produce research. Now the practice is still developing. Depending on who you ask, you will get different questions. How many unconnected analysts actually participate? In my experience, not so many, but this is the new set of rules, and everyone follows this now in the UK. The reason why I'm talking about this one goes to the point about dual listings. If you were to do, or if anyone from Latvia were to do a dual listing structure with an IPO in the UK, you would have to follow the UK model for the IPO. So you would need to produce the registration document first, followed by the prospectus, by the consolidated prospectus, which will contain the details about your particular tranche. Now, I'm running a little bit of time, but this is actually the last slide. So I hope it was interesting. I don't know if there are any questions. Please.
I do have a question. So would you see obtaining the credit rating for this company will go as a benefit as a part of the formula?
This is a capital markets transaction, but this is an equity capital markets transaction, right? We don't necessarily focus on credit ratings, right? We don't issue bonds. I think credit rating will be much more relevant, if not critical, in the context of a bond offering. In the context of an IPO, yes, people will pay attention, but is that the key driver of the transaction? I don't think so.